Hey everyone, Logan Hertz here with Hazeltine LLC, back again with D'Andre Clayton. D'Andre, how you doing?
What's going on, Logan? Man, it's a pleasure to be here, man.
As always. So I thought we would D'Andre would talk about something that is, I think, very often overlooked, but is probably the most important part of financial planning, and that is the psychological dimension. Something that a lot of standard conventional wisdom completely ignores, treats people like they're robots, and is super focused on numbers as if that's the only thing that matters. But when you look at the people who have been successful with money, usually it has a whole lot more to do with psychology. And this is why I like to compare financial fitness to physical fitness, because likewise, a lot of the people who succeed with physical fitness, it has more to do with psychology than being a brilliant or something like that, right? Or finding some super cool shortcut, right? They may have done it. In fact, a lot of them may have done it in different ways, but what made them successful was the psychological aspect. So, with that said, DeAndre, you want to share some of your insights on the psychology of money?
Yeah. It's funny because I had really went back to it after so many different LinkedIn type battles and all that kind of stuff, and realizing that many financial advisors, CFPs, where they lose the mark is they act as though everything will perfectly work out, right? And so I made a comment about many of them have probably never read The Psychology of Money, because I had just decided to get back into the book, and I think it's a fantastic book. But in realizing a lot about how great the book was, and looking at it from an infinite banking lens, and being like, okay, well, and even velocity banking as well, um, I was like, wow, there's a lot of really, really good nuggets in here that can help people to understand, even when they think, oh, infinite banking is a scam, they might not realize that it actually leans more towards the correct psychology of how you could work and actually be successful long term. So there was a few things that really, really took my notice, which I think most people need to realize. And this is something that you and I talk about before on podcasts, learning the difference between investing and saving, right? And I think you and I, we could, I mean, in some of the podcasts, we've actually went over some of the numbers of how bad the 401k values were because people were using the investment accounts like savings accounts, right? And then you have those who are, tuition has gone up 120%. And what are they doing? Well, they're saying 68% of people would be willing to use their retirement accounts for paying for schooling, right? So this is a problem we're seeing because most advisors don't focus on the psychology of a person and how to get them to the most successful place possible. So the coolest thing I would say as far as starting off was the room for error. I think the room for error had so many different nuggets in it, but also getting wealthy and staying wealthy was also a really, really good one. But when I looked at the room for error, I really loved that in particular because it played this game where when people get into the market or they do something like that, the reason why they fail is often because they can't stomach it, right? So, and why can't they stomach it? Well, they haven't actually saved enough money to have room for error, right? Like, imagine if you were like, all right, well, my name's Logan Hertz. I want to go and invest in this next home for a fix and flip. And all the money you had, you put into the fix and flip. Well, your need for it to actually work goes up tremendously. You have to get a profit. You cannot come in under budget. There's everything has to work out perfectly. And I think you and I would agree that in this world, things don't, right? There's always going to be something that comes up. And I really like that aspect of room for error, right? So it states, this was a quote, the most important part of every plan is planning on your plan, not going according to plan. What do you think about that, Logan?
Yeah, I think it's great. And of course, most financial advisors would claim that they do this, but they really don't. Um, they don't stress test their model. I don't even think they don't have models, let's be honest, but they don't stress test it. And when I say stress test it, they're probably thinking, well, yeah, here's what if the market crashes, just wait a few years, it'll come back. I'm like, I'm not necessarily talking about the market crashing.
Right.
I'm talking about something that happens to you personally. The market may be doing great, but what if you get sick? What if you become disabled? What if you have some negative traumatic emotional event, right? I mean, the fact of the matter is all of us are probably going to have something like that happen to us in our personal life. At some point, we're going to get kicked at some point. And it's not just the financial impact, but the emotional impact as well, right? Why do so many, to your point, so many retirement accounts, it's a pretty high percentage, get rated early. And it's a pretty high percentage. I don't know, I wish I brought the numbers offhand. I think it's like 40%. It's something pretty high,
Yeah.
right? So how can you say that these standard financial plans are working if in like 40% of cases, and I'm sorry, don't quote me on that number, but whatever it is, as I recall, it's high, it's not going according to plan. And it's probably not because the market crashed, right? That's probably not the reason.
Hmm.
Although that could be part of the reason too, right?
Yeah. I mean, obviously, market crashing is probably one of the most damaging things for a person who hasn't had money saved up, right? I think because they look at the money a lot more literal. For instance, and especially depending on the size of it. So, like if you have a person who makes $60,000 a year and the market drops and they lose $120,000 in their portfolio, they feel like that's 2 years, right? Like, and that hurts.
Hmm.
So then they start saying, well, I might need to stop investing in this. I need to step away from the table because one, they may not even have that much saved up. I see on a regular basis, especially when it comes to velocity banking appointments, is that there are so many people who might have a decent amount in their 401k, but don't have that much in their emergency savings fund, right? And invariably, what's going to happen every single time is they also have other debts outside of it. And a lot of advisors are not connecting that that is a problem. So you hear the average advice, oh, max out your 401k, max this out, max this out, max this out. Because they're talking about investing and they're not talking about living, right? And people have to live in the meantime. And I think that's the reason why I really love the room for error aspect, especially when we talk about what we do with the frugality aspect of how we want to approach something like infinite banking. We want something that's sure. We want something that is not costing an astronomical amount of money for what we can expect. And a lot of times, there's no expectation given anywhere else, but people act as though there's no cost. No, there's a cost.
Hmm.
If a
Hmm.
person's taking $600 out of their paycheck every single pay period, and then they still can't expect anything, you have
Hmm.
to be able to brace them. They have to have some type of shocks put on them for when things drop because they haven't been putting that $600 towards paying off their debt. They haven't been putting their $600 towards saving, right? Which ironically, the book actually talks about saving being the number one way to success, not investing,
Correct.
right?
Correct. Because everyone jumps to this totally meaningless return on investment metric, which is
Right.
just an advertising metric from Wall Street. It's a way to psychologically manipulate you and putting your money in their vehicles because they can advertise a higher return on investment, but it's totally phantom. And of course, in the case of retirement accounts, you give up access to that money for a significant period of time.
Yeah.
Um, yeah, and I think you're right. Like you've said before, they misrepresent investments as if they were savings when they're not. When you're putting your money into a retirement account or into mutual funds or brokerage, that is not savings. That
Mm-mm.
is investing. That is, in my opinion, speculative investing because real investing gives you cash flow. when you put your money into cash flowing real estate, when you start a business, start a side hustle, you're generating income. That's what it's all about, trying to generate income, right? So you
Mhm.
start off life with your active income, your full-time job, your business, whatever it is, right? And over time, you try and generate multiple streams of income that will at least eventually give you passive income. And once you have enough passive income that you can live off of the passive income, now you become financially free,
Yeah,
right?
absolutely, absolutely. Now, just to because I like to give him his credit, the quote, the first idea, simple but easy to overlook, is that building wealth has little to do with your income or investment returns and lots to do with your savings rate.
Very
And
true.
you don't hear that from too many financial advisors, right? You hear the max out conversation into investment vehicles. You don't hear maxing out into actually having reserve capital on hand. Now he goes into why that's the case, and there's so many different nuggets. Intelligence is not a reliable advantage in the world. That's because that has become as connected as ours has, but flexibility is intelligent. So it's one of those things that when a person realizes that the flexibility that they have to make the investments that they want to make, that the returns are higher, right? And he goes through that very well. Even, of course, he's using market terms, but we can use the terms of just life in general. There's a house here. There's a business that we want to invest in. There's whatever we want to invest in. Do we have the capital on hand to do that when we need it? Because those opportunities lend a much larger return than simply just taking everything out of my check all the time and sending it here, right? Because I don't get the opportunity. Now, he goes through also talking about how Warren Buffett's opportunity is really, really interesting. He's had a lot of losses, way more than wins. He's known as the greatest investor. But why is he known as the greatest investor? Because of when he took the biggest opportunities, not because of this consistent amount of money that just flows through as a paycheck, but because there was instances where he saw a company in its infancy or whatever he was doing, and he said, "Hey, I'm going to put money into this, and this is going to really, really help me long term from a dividend perspective." But he highlights his frugality. He highlights a lot of things as far as making sure that your books are right and not risking anything. It's funny that when you meet with an investment advisor, they have this kind of this pitch. Hey, Logan, when you're 18, you're young. You got time to lose. So you should invest in high risk, right? I've never seen it said anywhere where Warren Buffett told people to invest in high risk. And I'm amazed that most advisors are advising different than what he would actually tell people to do. But there's a reason why they're doing that. And one is because they actually base things on annual averages and they look at the returns over history. And even though FINRA, even though SEC tells them not to base future performance on that, they base all of their planning on what has happened. I've always found it really, really interesting, that that is just a normal occurrence for them, right? But here's another statement in the chapter about reasonable being versus rational. Aiming to be mostly reasonable works better than trying to be coldly rational, right? Um, Now, why is he saying that? And I think investment advisors really need to look themselves in the mirror about this particular point, is that things change. Even in our lives, our health, we can try to eat as good as we can. Is it still possible to get sick, Logan, even if you eat good? And of course, it's a part of life, right? Um, But if you plan and think that it's impossible for something bad to happen, what's probably going to happen? Something
Yep.
bad.
Something bad.
Something bad. I mean, it's
And then you'll be the other aspect of that too is when it happens and you didn't prepare for it, it's all there's a psychological element to that too,
mm-hmm.
right? When it comes as a surprise versus when, let's say your home burns down, right? Well, that would be a shock, but hopefully you had homeowners insurance, right? So
Right.
there is a psychological benefit to that where you can deal with that much better knowing, well, I have a contingency plan in place,
Yeah.
right? Because if you really take the logic of the standard modern financial wisdom to its logical conclusion, you should never own any form of insurance
Never.
because everything they're talking about is based on probabilities, right? They're just saying it's likely that this artificially created metric known as S&P 500 is going to go up at a certain rate. Well, that's gambling. You're telling me to gamble my entire financial future on the proposition that an artificially created, managed and manipulated Wall Street metric like the S&P 500 goes up at a certain rate for like the next 30 years. I
Yeah.
mean, who in his right mind thinks you can predict what the market is going to do? And it's not a market, first of all, what this metric is going to do over the next 30 years, right?
Yeah.
And
Yeah.
even if it turns out to be right, you still are taking on way too much risk. Just like the analogy I always use is if we're talking probabilities, okay,
Mm-hmm.
there's only like a 4% chance that you're ever going to file a claim with your homeowner's insurance.
That's a
Hopefully
fact.
you never do,
Yeah.
right? So why don't you take that money you're wasting on homeowner's insurance, put it in the market instead, and get this great return? There's a 96% chance you will come out ahead if you do that, right? Of
Mm-hmm.
course, there's a 4% chance you'll be ruined, but come on, it's 96%, right? Those
Yeah.
are great odds,
Yeah.
right? So apply that same
How
logic
much could
here.
you make? How much compound interest could you make off of the money from your homeowners?
Right, right. So
Like
apply the
that's
same logic here. Let's say it's 96, there's a 96% chance that the S&P 500 is going to go up 8% or more per year for the next 30 years. I'm not going to gamble my entire financial future on that proposition,
right.
right? I might
Right.
gamble a small amount of money, but if I'm going to gamble, if I'm going to speculate, it needs to be better than an 8% return that I'm shooting for. It needs to be, probably 1,000% return. It needs to be something that has that kind of potential. And I'm only going to invest very small amounts of money, right?
Right.
In a few high potential speculative investments. And because I'm calling things by their proper names, I'm not calling it saving,
You're right.
not even calling it investing, I'm calling it speculating. Psychologically, I understand what I'm doing. And so it's not a big blow to me when one of them blows up because I knew it was speculative, right? I'm going to put that in a separate part of my portfolio. And psychologically, I'm going to put it in a separate part. And what I do for myself is my speculations, I just put them off the side. Don't even calculate when I'm calculating my net worth or whatever. I don't even include it.
Right.
That's just off to the side.
Right.
So if I lose, it doesn't psychologically hurt because I was never counting that to begin with. And if I win, great. That's a great,
And
nice
wonderful.
added bonus,
Yeah. And
right? And
wonderful.
you gotta realize gains too. Like when you go and buy an asset like a mutual fund or put your money in a 401k, the only time you make money is when you sell. That's the only time you make money. So if you're going to buy an asset like that, before you buy it, you need to ask, when am I going to sell?
Yeah.
What's the trigger for me selling? Whatever that is.
Yeah.
But that's never even discussed.
Yeah.
It's just you're going to leave it there forever, right?
That is true. That is true. Distribution is something that they avoid like the plague, usually. Um, and I think that
Because
it's
they
just
don't want to give you your money back. They don't
yeah.
want to give you your money back. They want to keep it forever. It's the four rules of financial institutions. And that's why I say again, don't invest for capital gains. Invest for income. Invest for income. When you look at, Chris Miller was talking about this, but I'm sure many other people have done the study. They look at self-made millionaires. Generally speaking, they invested in two things: businesses and real estate,
Yeah.
because those give you cash flow. Okay. And if you are and when you look at the sort of the millionaire next door, um, the reason they got rich is not because they got a great rate of return. It's because they were very disciplined savers.
Yep.
And I don't know, a lot of them probably did this. I don't know how many of them put their money into some market-based account versus how many of them just saved it. But if you had said, don't put it, don't do 401ks, don't do mutual funds, just take all that money and put it in a savings account, I bet they would have come out better because they would have been insulated from all the downside.
Mm.
And again, to the bringing it back to this, the psychological importance of having certainty, right? You are going to be more disciplined and you are going to find it easier to succeed when you have certainty in your plan. If you're throwing all your money at the S&P 500, you're now introducing a large degree of uncertainty, and don't kid yourself, that is going to impact your ability to execute.
Yeah. In fact, on that point, because I really do love this book, right? Um, History can be a misleading guide to the future of the economy and stock market because it doesn't account for structural changes that are relevant to today's world, right? Now, a lot of people may not really think about that, but Zoom, for instance, right? Like we're going through Zoom right now. There was a time when Zoom existed and nobody cared. I hate to say it, as much as I'm on it every day now, there was a time when Zoom existed and nobody was in a rush to use Zoom. After the pandemic, you may notice that Zoom has added all types of stuff because their evaluation continued to rise during that time. Right now, Zoom is dropping. Why is it dropping? Because people are getting back outside. People are, going back into office. They're doing more things. That was a structural change in society, right? Now, 20 years from now, you're probably not going to hear a lot of people saying, "Hey, you need to invest in Zoom." It's been around, it's old, by then it's going to be very old. It's going to be something people are just used to. Who knows? Hopefully it becomes a blue chip one day, but we have no idea. But that's the importance of understanding the hiccups of what is going on with the market, right? The market responds to structural changes. So, yes, there are fiber optic companies and all that kind of stuff that are doing well right now. But if you would have put that back 70 years ago, 60 years ago, nobody would care. We ain't have cell phones, right? We, 3G
Yeah,
technology didn't exist then.
right, right. When they're projecting those returns forward, again, I like you, I always find that kind of silly because the market even 10 years ago bears no resemblance
No
whatsoever to market
resemblance
today.
at
So
all.
how can you say that what happened 10, 20, 30, 40, 50 years ago, even if it's been happening for 50 years, what bearing does that have on the future? You've got to tell me why. And they never even ask that question, let alone answer it. It's just this religious superstition that this S&P 500 metric that we're supposed to worship
Mhm.
just goes up. And that's just it's just a religious superstition. My question is why? And if you can tell me why, like if you can give me legitimate reasons as to why you have a reasonable expectation for that, well, that still doesn't give me certainty, but at least that would be more of an investment thesis, right?
Yeah.
But they can never give you any why. It's just, well, that's what it's done for the past so many years, right? Oh, and don't pay attention to those crashes. Yeah, it'll all average out, like, well, I
Yeah.
mean, I don't see how what I do not understand why anyone thinks it's relevant that this metric and what it did in the past bears any relevance whatsoever to my personal financial life. I don't see how that's relevant to me at all. You might as well tell me what the betting odds were for a sports event that happened 10 years ago. I don't see how that has any relevance to my life whatsoever. The reason why it's so prevalent is because it's the strongest advertising gimmick for these inferior Wall Street vehicles in which people throw tons and tons and tons and tons and tons of money And they use this metric as a means of attracting that money. It's just advertising.
Yeah, absolutely. Um, Now, and there's one thing that I've found that is really insidious about the financial advising now lately. You may have seen it, but I see it more and more often where the scarcity that it creates in a client is that they no longer even care about their family's well-being, right? So it's like, hey, let's make sure you have enough money at this point and you spend all of it and you don't need any insurance because everybody is, 30 or 40 years old when you die. And like they're trying to make people think only for their lifetime. And I think it's a realistic metric in seeing 70 or 80% of people without any legacy that they're leaving behind for anyone. And I don't think that's a surprise when the advice is to spend all the money you have until you die, right? Um, so there were some things that it mentioned about, and I want people to understand when me and Logan are talking about this is not saying you can't invest in the market or whatnot. What we're actually saying is there are some things that are just not worth risking, right?
And proper order of operations.
Proper order of
Build
operations
your savings first. So I have
first.
my
Build
pyramid,
your
right?
savings first.
At the bottom is protection. At the bottom is protection, which are things like insurance,
Right.
right? Have life insurance, have car insurance if you own a car, have homeowners
Mhm.
insurance if you own a house, have liability insurance. Basic
Absolutely.
stuff, right? Protection first, then savings, right? So build your savings, then investing, and then speculating at the
Then,
top, right? And
yep.
because it's a pyramid, you can see what your asset allocation should be, right? What the foundation is,
Uh-huh.
right? And the majority of people put the majority of their money into speculating, mutual
Absolutely.
funds, 401ks, right? If
Hmm.
you are putting your money in and hoping for some sort of return on investment that is not guaranteed, that's speculating. That's
Yeah.
speculating. Real investments give you cash flow. Real investments give you income. Like Robert Kiyosaki says, it's not about return on investment, it's about cash flow, right? And so to your point, DeAndre, I think what you and I do that I think helps people a lot more psychologically is we give them immediate concrete results, right?
Yep.
You're paying down debt faster. You're seeing this weight that you're carrying get lighter, right? That has a psychological benefit to it, right? You have protection in place with whole life insurance. You know that if something happens to you, your family's going to be protected. If you have a long-term care event, your
Psychological.
family's going to be protected. You know the money in whole life insurance is creditor protected. That has a psychological benefit. You know you have certainty. Your cash value will go up every single year, no matter what. It's guaranteed. You have certainty, right? And so then, ironically, once you have that in place, you can actually be more successful with your investing because you'll have the patience and discipline to do it properly.
Yeah.
And I was having this conversation with a client. He's like, "What?" Trying to figure out what he should do with his money, and I'm telling him, resist that FOMO, right? Resist the fear of missing out. Resist the urge to put your money to work for you. That's the
Hmm.
scarcity mentality you're talking about because they think they can only use each dollar once. They're trying to get squeeze the most out of it instead of
Yeah.
putting their money into whole life insurance first and then taking out a policy loan where now they can have their money working for them multiple ways, creating that velocity of money, right? I'm
Yeah.
telling you, the more you build capital in whole life insurance policies where you have a guaranteed tax-free rate of return, the more disciplined you're going to be about finding a real investment. You're not going to be tempted to just start putting my money to work for me because you know your
Yeah.
money's working for you.
You know your money's
It's
working
working
already.
for you 24/7.
Already
Every
working.
time you look, your cash value has gone up
Yeah.
without you doing anything. So you're going to be more disciplined about waiting for when do I have a real opportunity? And a real investment opportunity, again, getting back to psychology, is specific to me. What is my investor DNA?
Hmm.
There are lots of great investments out there, But what's a great investment for me? That depends on my psychology. So it's ridiculous to me that everybody puts their money into the S&P 500 as if everybody had the exact same psychological makeup.
Yeah, yeah. Now, it's funny. There were so many different points that you brought out there that were in line with it. One of the things they brought out was freedom and independence are invaluable, right? And that's a part of the things that aren't worth potential gain. Freedom and independence, right? And I think a lot of people, they speak down on guys like us who focus on infinite banking, but what we're really trying to help people to see is your time is worth something. Like, don't just throw your money somewhere where you have no idea what it can do, what it will do, what it should do. Throw it somewhere where you can actually control more of your outcomes, because if you control more of your outcomes, you control more of your time. When you control more of your time, you get more time with your family, the things that are actually more important than just chasing returns. I've seen, and I don't know if you've ever dealt with this before, but I've had some clients that when I'm about to help them with like an annuity or something like that, a lot of them don't know their values. And the reason why they don't know their values is because they're terrified to look. Is that a way to live? Like, I mean, really, is
Yeah,
that a way? That's not a way to live. That is
yeah.
not a way to live. You should be able to know what you are actually doing, where it's going, how it's supposed to perform, and what it's going to do for you in the long term. The other aspect is when you have that flexibility, and one of the points that the book brought out was wealth is the ability to say no. It's the
Mhm.
ability to say no. So what you were talking about, like once you've gotten financial stewardship, you don't just jump to everything. You are a lot
Mhm.
more choosy. You vet it out completely because you're like, hey man, I know what's when something looks good and I know when something looks bad. I'm not just gonna throw it out there because I'm not desperate.
Mhm.
I'm not desperate. I'm not in a fight or flight at all times. And I think when people over promote the market, they put the average person in a fight or flight at all times. And then
Yep.
they end up in that fight or flight when they're in those years that they would call the retirement years. The
Yep.
sad part about that is when you look at the metrics, the retirement advice doesn't work. It doesn't work. 95% of people say that they don't think they can survive and keep the same lifestyle that they had while they were working. The advice is so out there. One of the things to combat infinite banking, I remember a guy said, "Hey man, all you insurance guys, you talk about the insurance, you talk about the taxes going up in the future, but for most clients, they're going to be paying less taxes. They're going to be in a different tax bracket." And I had to let them know. I said, well, if you're telling your clients they're going to be in a different tax bracket, they shouldn't be your client. Why would I be happy making less money?
Right. Right. That was always
why,
my initial
why, why,
response. Like, I
why
don't
would
ever
you
want to,
tell
yeah,
me?
I don't ever want to be poor. I don't want to
It
be,
makes no sense.
yeah, I would want to make a high income, as high of an income as possible for as long as
Right,
possible. And if
right.
that puts me in a higher tax bracket, that's not necessarily a bad thing,
No,
right?
no.
I mean, so yeah, why are you planning to be poor in retirement? I don't understand this.
Why would you plan me to be poor in retirement? So I'm like, that's a failure in itself because a poor person can't leave an inheritance to anyone.
Yeah, no, the failure is inherent in their plan also because when you first get started with putting money into a retirement account, I remember it was like the most depressing thing I've ever heard. Oh, and you can't touch it until age 59 and a half. And I'm like, wait a minute. I want to retire tomorrow. Like I want financial independence tomorrow. And you're killing my dreams right from day one.
Yeah,
If you're going to lock up my money in jail for like 30 years, you better be promising me something astronomical, right? Because the time value of money over 30 years is enormous.
absolutely,
Enormous.
absolutely.
I'm pretty sure I could find a use for that money now
Absolutely.
that would yield much better results, right? So the loss of liquidity, access, and control, and the psychological impact of having control and having certainty is huge, right?
Yeah.
To your point about being in fight or flight mode, that's what happens when you're letting somebody else dictate your financial future, where you're now biting your nails hoping the S&P 500 goes up.
Yeah. Nah. It is not the right way to go. Now, the last thing, because I know I got to head out in a little bit, but the last thing I will state that, and I think, Logan, you've naturally done this throughout your time where a lot of these points, you somewhat touch on them, right? You somewhat touch on them. And one of your points that drew me to you when I first saw one of your videos was about the prison of the 401k, and how when you lose, you stay in and ride it out. When you win, you continue gaining, so to speak. So it's like there's no time when I'm ever supposed to take the money. Um, there was a statement, one of the first statements in the book is the hardest financial skill is getting the goalposts to stop moving. Getting the goalposts to stop moving. So a lot of times when you're told to continue staying here, the goalposts moved. It moved. And then when it got better, and then now you're in retirement and they're telling you, no, 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 only draw 4%. The goalpost moved again because now we're trying to stretch it for this amount of time. And it's a continuous station of goalposts moving the entire time that really is programmed into people by a lot of financial advisors. Because if I can't give you any expectation, I have to move the goalposts all the time.
Mhm,
If
mhm,
I can't give you a guarantee, the goalpost is going to move. You just got to be used. You got to be okay with the goalpost being moved all the time. So I love this book. I think that anybody who's listening to the podcast, if they want to understand a little bit about why infinite banking guys do what they do, this is a brilliant read. It's not necessarily about infinite banking, but it's about the psychology that we use when we approach money. We believe you should be saving first. We believe you should be protecting, saving, and then investing, and then speculating, not save 6 months of an emergency fund as if that's going to get you through anything, and then go head into investing, maxing out everything that you have, for something that really isn't that large. That's another conversation. The
mhm.
the deduction is not a deduction. The deferral, it's a delay of taxes, right? So all of these ones who are like, well, but I had a guy tell me the numbers work out that the reason why you get rid of the liquidity is because the deduction serves to make sure that it makes sense for you. For most people, for every $500 they put into a 401k, they probably get $31 of a deduction. It's not really that much money. But more
Yeah,
people really need to know that, to understand that if I had this control, I could stay out of debt. If I had this control, I could build a savings that will allow me to actually purchase something that will draw me more income. $100,000 in a life insurance policy, cash value, $100,000 in a house is going to make you more money than $100,000 in the market. That's just a fact. There's no way around it. But
yeah. And maybe in our next video on this series, we can talk about the psychology of money from the other side of the spectrum, meaning how does Wall Street and the banking system change and manipulate the meanings of words in order to psychologically manipulate us into doing what they want us to do, right? So to
absolutely.
your point, they misrepresent an investment vehicle as if it's savings
Yep.
when it's not. When you put your money into the bank, they call it a deposit, but it's not. It's actually a loan,
Well,
right?
hold on. Number one, the number one, we're going to leave off on this one. They misrepresent the word security. That's a big thing. They misrepresent the word security. A securities license gives you the ability to sell something volatile. Volatile and security are antonyms. They are not synonyms.
Right.
You
Right.
know, and
Right.
it's crazy that people don't see it, but it's like, okay, when I was thinking about, hey, I might get a license for this or whatnot, and I'm like, I just don't understand why I have to get a securities license to sell something that is volatile. I was like, shouldn't the insurance license be considered a securities license? But we can talk about that another day. Look.
Yeah. All right. Yeah. Well, the psychology of money, that's what we've been talking about today. And I think it's important for people to take this into account when doing financial planning. And there's a lot more we'll hopefully say on that in the future. But D'Andre, thanks as always for your time and your insights.
Thank you, brother. It's been a pleasure, man. As always, I get a lot from watching you, man. I
Oh,
love
thank you.
seeing what you
I
guys
appreciate
do.
that. I appreciate that. Means a
Watch a
lot
couple of
coming from
nice
you.
ones. And that calculator, hold on. What did you do recently that was so awesome?
Was
I
showing how you can optimize the first lien HELOC by
ah,
paying your bills at the end of the month, right? Yeah.
it's perfect. It was perfect. I was
All
like,
right.
yo, where'd it go? I'm cheering them on.
Thank you so much, DeAndre. Greatly
All right,
appreciate it.
brother. You have